Well, good morning, everyone. It's February 26th. It's a Wednesday today. February's almost behind us. We got 3 days left because this year it's a leap year. We have 29 days instead of 28 days. Let's get into it. Everybody wants to know what's going to happen with the market, if we're going to go lower, if this is going to be a crash, how long this virus outbreak is going to last. And again, folks, this should not be a surprise to you. This should not be a surprise. And I'm going to tell you another thing. The market was grossly overbought. This virus, it's just a catalyst for the downside. Most of the downside is occurring because the markets have been fragmented and overbought. This virus is just an excuse for pressure selling. But it is serious, something we have to pay attention to. It looks like Greece has now been infected with the first case. Things are not getting any better, folks. As a matter of fact, just as I found something here I wanted to show you, something actually interesting. Outbreak originated in China, now infected over 80,000 people globally. South Korea's Center of Disease Control, 134 of the new 169 cases. So there is an outbreak. As a matter of fact, I read earlier today that someone in the U.S. military was infected as well. So here it is. South Korea virus cases jumped again Wednesday, and the U.S. military confirmed its first case among soldiers based in the Asian country. That is not positive. But again, the market's assimilating all of this. It's pricing in everything it knows ahead of time. The question now is, how long will this last? Well, as I told you before, we're now at the twilight zone. We broke the 50-day moving average. Folks, look at this overbought level. Every time you see this blue, this means the market is overbought. Look at this. Entire November, entire December, entire January, almost entire January, all of this is a stretched out market. It needed to correct. This is very, very healthy. If it wasn't the coronavirus, it would be something else. Again, if we break the low, 311.46, I would say 311, use that as a target. The odds are we are going to go to the 200-day moving average. Let me show you something very interesting. As you may or may not know, the U.S. stock market is capitalized weighted. That means the bigger the stock, the more power, control, and say it has in the index. So for example, Apple has a lot more influence on what the S&P 500 does than say Time Warner, probably 8 times as much. I'm guessing, but I'm probably pretty close based on everything I know. So I wanted to show you the index. There's a version of the S&P 500 that a lot of people don't know about that can show you what it would look like if all the stocks were equally weighted. That's right. A lot of people didn't know about this. This is where we're at right now. We're literally at the 200-day moving average if you look at the S&P 500 from an equal footing. So the market is actually weaker than you think it is because you shouldn't take that market cap into account when you're looking at a broad-based rally or a broad-based correction. You're looking at whether or not a stock is being sold, not how powerful that stock is. Because look, what if Apple is going to be a buy and everything else is going to be a sell? It's going to distort the market. We don't want to look at it that way. We want to look at this apple to apple, not apples to oranges. So this is the most undistorted vision of the S&P 500. And as you could see here, it's right at the 200-day moving average. I don't know if this is control, but this is a good indication that we're close to being done. Let me show you something else. Small caps. Small caps are touching the 200-day moving average. They have a lot more influence with China than the broader market. So again, they're already at the 200-day moving average, and the equal-weighted S&P 500 is already at the 200-day moving average. The S&P, the broad market, the 200-day moving average, is at the 304.50-ish level, and we're already oversold, deeply oversold. Remember this? Now we're seeing it to the bottom side. What you're seeing is this. You're seeing a rubber band that was stretched out, and then stretched out some more, and then stretched out some more, and then stretched out some more, and it finally popped. If the rubber band stretches out and pulls back, stretches out and pulls back, the market can work that way. But what you're seeing here, ever since this date right here, late October, right around my birthday, October 29th or so, the market, that rubber band has been stretched out and it hasn't gotten the opportunity. It has not received the opportunity to contract. So that's what happens when you have that. That's ultimately what happens. The question for today will be whether we could stay above 311.50 or if we're going to go down to the 200-day moving average. If we break 311.50 or 311.46, just say 311, the odds are very strong we're going to hit the 200-day moving average, and we're going to break the 200-day moving average on the equal capitalized weighted index and the Russell 2000 as well. Now, let's look at sentiment. Put to call ratio. What did I tell you yesterday? It closed at 110, 115. I told you yesterday it'll probably end up being at 130. Now we're talking about legitimate, strong panic. The market was in panic mode yesterday. It wasn't in a panic mode the day before, but it was in a panic mode yesterday. And now the put to call ratio is 131. Now let me show you something here. Let me go 2 years so you could see how high it usually goes. So one time we went high, but notice when we get above look at these peaks. This is about 140, 140, 142, 130. When we get to these levels, the market is now becoming too oversold. So we could see a little bit more downside, but I think the majority of the downside action is behind us. Furthermore, gold. Gold did not rally yesterday. It stayed in a range. That's very, very important. Interest rates, bonds sold off. This is yesterday. This is already this morning. They're down right now. Bonds are lower. They're not higher, okay? Now, they could rally, but the bottom line is, remember I told you this gap is going to fill? And we're having, let me erase this line. It's like a thorn in my side. So again, let me just show you. This is let me go a little further back. Why am I having such trouble doing this? Okay, here we go. Notice price action's getting higher highs. Notice on the oscillator, the momentum levels can't rise as high as this, but price level is higher. That's divergence. That's exactly what we saw on the S&P 500. Higher highs, lower highs, and then boom. And now we're seeing the same on the bond market. So the bond market so far is cooperating. Gold is cooperating. It did not make higher highs yesterday, even though the market sort of crashed a little bit or fell pretty hard. Had the two biggest days in history. Gold did not rally. Put to call ratio, overbought already. And most importantly, VIX. VIX is look at this. Let me show you 2-year chart. This is not a huge level. We've seen higher levels of VIX. But this is a fairly interesting level for warning sign. This is telling us the markets are in a fear level. But again, with this type of downside, I would expect us to be at 30 or higher. And the fact that volatility is not going much higher, the fact that bond market is cooling off and is starting to fill the gap already, the fact that gold hasn't risen and has peaked out after volatility 2 days ago, not even yesterday, but 2 days ago, and most importantly, the put to call ratio at 131. And then again, S&P equal weighted, it's already a 200-day moving average. The broad market S&P is already oversold, and the small caps look like they've bottomed out. So for today, I'd like to see the small caps. What I'd like to see today across all of these three indices is I'd like to see price action remain at the upper end. There's a good chance we'll break down, get some stops in, and then come back up. But if we go higher today or have an inside day for the next few days, there's a good chance the panic may be behind us. Also, it's going to be very hard for put buyers to increase this exposure. So the market is stretched out now again, but not to the call side, but to the put side. And again, check out this ticker symbol, RSP. It's an equal weighted S&P 500 index. And I think you'll be surprised when you're looking at the market when all 500 stocks have an equal weight versus capital weighted indexes. When like right here, when the markets are pushed up by a few stocks like Apple, Google, Microsoft, Intel, those have more. There's like 10 stocks in the S&P 500 that have more market cap than 300-400 others. So you've got to look at the equal weighted one and the capitalized weighted one at the same time so you get a good idea. What I do is I look at momentum levels. I look at the percentage of stocks trading above or below the momentum levels. But right now, with the put to call ratio so high and with the non-capitalized weighted S&P at the 200-day moving average, and with gold not breaking higher and with bonds not breaking higher, I think there's a really good chance the market is overdone for now. So, folks, I hope you can appreciate, after seeing this, I hope you can appreciate why The big goal for all of us is to reduce risk. If you can reduce risk, the gains will take care of themselves, especially after this week. I'm sure you understand why risk is very important. Now, personally, me, I like to use hedges. I like to use bonds. I like to use gold. I like to use volatility to hedge myself, and it works really well. But another way to decrease risk is simply to use a time stop. A time stop is when you're limited, your time in the market is limited. So for example, imagine you're in and out in 24 hours. Not day trading, not in and out the same day, but in and out in 24 hours. That's a really, really good way to maximize your upside and minimize the time you spend in the markets. You get in for quick moves, you get out quickly. And there's one trader who's made a career, literally made a career of these 24-hour trades. I'm not kidding. He deciphers data from the options market to give you the strike, the moment the stock is going to strike. Even though the trades are very short-lived, his gains offer triple-digit gains. Again, 24 hours in the market. You get in on Monday, you get out on Tuesday. You get in on Tuesday, you get out on Wednesday. You get in on Wednesday, you get out on Thursday. You get in on Thursday, you get out on Friday. Quick, nimble, you hit those trades and you run the other directions. You don't stay for these downside moves. So again, to summarize, it's a great way to reduce risk, and reducing risk is important right now. Imagine you're in on Monday, you're out on Tuesday. That's huge. So this trader will teach you how to reduce risk, use rule-based strategies that show option activities overbought or oversold. It's really, really cool. There's a way literally to derive what the market will do based on what the options are doing. Options are a lot more sensitive. This is why I always look at my implied volatility. Options are very sensitive. So if you can use options to help you figure out what the stock is going to do, get in on day one, get out on day two, target triple-digit gains, not stick around for those downsides, that's where the money is. So follow the link below, get all the information, learn about this. You got to check this out. Follow the link below. Again, 24-hour windfalls, triple-digit gains. There's nothing better than that in this type of market economy. Follow the link below. Learn about this now. I'm really excited about this, and you should be too. Follow the link below. Learn everything you can about it. Talk soon.